You are listening to Mining Stock Education.
I would say certainly it was a 10-bagger that I missed out on.
If I would have bought it when I was considering it, it would have been a 10-bagger, but I passed. Thanks for tuning into Mining Stock Education, and in today's show, you're going to hear the monthly chat, Junior Mining Insights chat between myself, Bill Powers, and Brian Leni of JuniorStockReview.com. Brian's also a co-host on the show. Brian, thanks for chatting. And let's kick it off with a question we got from a listener after our last monthly chat. Great question. And the listener writes, in the future, I'd love to hear about an investment that you had your sights on but never bought. Then later down the road, it did really well. Were the reasons you chose not to invest valid, and what was going on in the cycle that affected your process?
It's a great question. And there's a few, definitely more than a handful that sort of fit this bowl. But I would say the reasons why I did not invest were pertinent, although it still sort of stings in retrospect. The company was Filo Mining. This is going back, I forget the exact year, probably 2021, maybe 2022. And I had taken a meeting with Jamie Beck, talked about the company, had a bunch of questions, liked what I saw. And the reason why I ended up saying no or deciding not to invest, because Argentina at that time was still sort of a basket case. There was a lot of question marks in terms of where things were headed. There was always the question mark of, how this thing is going to play out in terms of the government and their view on mining. And because I had such a big investment in AbraSilver, which is my biggest win that I've had in the mining sector to date, I thought, I've got enough risk with Abra, and I will pass on Filo, although I do think it's quite an interesting story. Now, I can't say that I extrapolated forward and foresaw what has happened, but that is for sure one of the ones that stings in retrospect. But I think I did make a good choice as an investor to say, hey, look, there's only so much jurisdictional risk that I want to take. And Argentina at that time was probably amongst the most risky. And therefore, I just stuck with what I had and what I knew instead of taking on something new. And so I'm overall happy with how I went through the process, but it certainly stings because Filo is one of the best.
Okay, so two questions. First one is, what was the share price at the time, and what would have been your gains to the buyout price of Filo Mining?
That's a good question. It certainly was in single digits, and man, it was well before all this exploration drilling. Really, it's if you go back to their basic PEA, and again, I think this is 2021 when I took a look. And if you go back to that time period, like there was nothing really to say that they were going to hit these kilometer long of 1% copper sort of intercepts. But I thought the project itself was quite interesting. And I believe it was a high sulfidation epithermal portion that they had. And then of course the porphyry upside. But again, like those things are so hard, at least for me, to sort of gauge into the future. And what I saw at the time was risk and it contrasted against a company like AbraSilver that had already run for me. I was making money off it, knew the management team very well. And so that at the time, it was quite easy for me to pass on.
So it's at least a 5x or 10x from where...
Absolutely. Absolutely. I would say certainly it was a 10-bagger that I missed out on. But I don't recall what the exact share price was.
Did you change your process as a result of that experience, looking back now, years later?
No. I like I said, I'm quite happy with myself. You need to set barriers to yourself as an investor. And for me, like I've always been set on rules that I invest by. And that is something, assessing risk and deciding, especially in South America, like although I think that there's risk in all jurisdictions, I think South America, you have to be very careful about, where you invest and where you place your money and what your expectation might be, for that jurisdiction moving forward. And so for me, yeah, like the percentage that AbraSilver represented in my portfolio at that time, was more than enough in terms of the risk associated. So I think it was a good decision, and that's going to happen. And I'm okay with that. I'm okay with missing, those big winners, as long as I'm making good decisions on the other side. In AbraSilver, it's a 35 or 3,600% win for me right now. So in contrast, I did very, very well, and I'm certainly happy with that investment.
So a decision-making process that I still hold today, like yourself, that caused me to miss a 10-bagger from about, I believe it was 2022 until today. If I would have bought it when I was considering it, it would have been a 10-bagger, but I passed. And in my thinking and in my process, the reason is I do not like when CEOs of a junior mining company, that is, are on social media and they're either acting unprofessionally or they're sharing too much of their views that are irrelevant to their marketing of the company, marketing of a publicly traded company on their social media accounts. Furthermore, this executive, I would say, is probably one of the most arrogant junior mining CEOs that I've observed in terms of how he acts on social media. Never met him in person. And also, he's attacked other junior mining CEOs that I think highly of on his social media accounts. So that did not cause any affection from me to him. And it was primarily because of that when I was presented with the opportunity, I took a pass on it. It's gone 10x since then. But like yourself, that's still my mode of operation. If a junior mining CEO, see, when I did in-home sales for the construction industry in Metro Detroit, two of the things I learned early on is when you go into a home, don't talk religion, don't talk politics. If you're there to sell siding, if you're there to sell a roof, if you're doing a bathroom remodel, stick to the topic, because the two of you, even if you have politically opposite views, you might actually like each other if you actually just sat down and talked and you stayed on topic for the reason why you were there. I relate that to, and you can lose a lot of sales. There were so many homes that I went up to that they had the politician sign in the front yard during the election season, and I was voting for the other guy. So I made sure that I didn't tip off or say anything about how I really feel regarding the political situation because it would cost me the sale. Relate that to a lot of junior mining CEOs that either act the fool or act arrogant or act in ways that are perhaps, in my opinion, not becoming of a CEO of a publicly traded company. Could they do well? Yes. Could they be knowledgeable? Yes. Could that share price perform well? Yep. But for my filter and for my process, if I see someone acting like that online, I'm not even going to consider it. Now, I know there are other people that disagree, and that's good for them. And I know people that made a lot of money off that stock too. But to the point we're talking about, your process is your process. You can tweak your process, but the stock that went 10x, I mean, look at Filo Mining. It was flat for what, a decade or more? It's 20 years in the making, right? So like you said, you couldn't have categorically 100% predicted those kilometer long holes that cause it to become what it is, but your process is your process. So I guess a follow-up question to this is, what would be something that you or I experienced that caused us to dramatically tweak our process? And Brian, when I've dramatically tweaked my process, it's not because of theoretical loss, something I could have invested in that I didn't, that did well, but it's actual loss. And it's actual loss when I find out later that the executives or directors were not fully truthful to me. And in those moments when I lost substantial money and I feel like there was less than forthright communication and operations, that is what has caused me to change my process the most.
And that's it. Loss is what triggered it for me too. Looking back to 2022, 2023, there was a lot of soul searching there for me in terms of what I was doing and how I was going to go forward. And it absolutely affected the way that I deploy money into the sector, and for the better. Without those losses, it's like you don't learn anything from your gains typically. It just reinforces whatever beliefs you have, and you can parlay that into probably so many other parts of your life where success confirms bias. And in this case, the loss and the fact that I was willing to reflect on it and accept where I'd made my mistakes has really put me on a different trajectory. And that pertained particularly to exploration and how I was going to participate in that part of the investment opportunities out there. And I changed it dramatically. And you can see of the companies that I've talked about in different presentations that I've given. And of course, any subscribers look at how the portfolio is constructed in Junior Stock Review, you'll see my changes are written all over that portfolio. The concentration, it's not that I don't invest in exploration anymore, but I do it very strategically. And it's with certain people, with certain business models. And then, of course, I play to my strengths, which I know it has been proven over the 9 years that I've been doing this by myself, is that, the developer, something with a resource that I can put numbers to, is where I need to be. And playing to that strength has led to great returns. Like the portfolio went from basically a negative return in 2023 to over 150% in the weighted average last year. And this year we're well up over 250% because of those changes that I've made. And for me, everybody's going to have to go through that process, but you have to be introspective of the mistakes that you make and make the changes accordingly. And it's iterative process being an investor. And like I said, it's taken me 9 years to sort of get where I am today. And I still know I have improvements to make, and I'm constantly trying to get better.
So I was interacting with a YouTube user in the comments, and one of the person says in response to a junior mining video, it's spray and pray time. That okay? So I said, you better be careful with that. And basically, because the macro situation is so good, it's spray and pray time. Throw all concern about risk or need for due diligence out the window. And your approach, I know, and my approach is more that of a rifle, to where you make sure that your process is getting that crosshair totally zoomed in and accurate, and then taking very targeted shots with a rifle when you want in terms of how you invest, versus like a spray and pray where you're just shooting everywhere hoping to hit something, or even a shotgun with a bird shot. For those that don't know, a bird shot is a bunch of small little pellets. So once it leaves the shotgun, it begins to spray and spread out because your target, the bird, is a little smaller. So maybe could you share some of your thoughts, Brian, in this gold bull market, like the spray and pray approach versus the rifle approach?
Bill, like this is probably one of the worst markets for what I'm about to say, because I think the spray and pray mode, unfortunately, in a bull market is going to work. It may not work as well as if you are more precise, like you're talking the rifle. But I think with what's ahead, your worst picks are probably going to make you money. And like I said before, you learn nothing from your success. Typically though, like over the 9 years I've done this, I've hit two really strong gold bull markets, 2016 and 2020. The rest of those years are sideways to down, meaning that there's no interest. You don't have the market, helping you out in terms of fixing your mistakes for you, where attention just moves share prices up regardless of almost what's happening. And that's a lot of new money that's trying to jump on momentum, and they see an advertisement or they hear someone talk about it and they buy the stock sort of not knowing anything. And so again, you get those mistakes are kind of clouded over. Whereas when you're in that bear cycle, you have to pay for those mistakes that you make. And that is where you're going to make the differential. For me specifically, like I think this is the approach that people want to go after, is getting better at picking individual companies. And that starts with valuation, the ability to go in there and understand what a company is worth. The exploration side is a little bit more difficult. And if you're brand new to the industry, I think you definitely want to focus on the bigger companies where you can look at the balance sheet and probably understand it a little bit better than when you get into exploration, and putting a number or quantitative value on that is just so ambiguous. But understanding value, understanding the discrepancy or the delta between the price of the company and what it's actually worth, and how that's going to change over time, is what's going to make you a better investor. Whereas the spray and pray approach is like, okay, you're taking that top down approach. I like silver, so I'm going to buy the first 3 silver names that I hear or I look at. And because they have 100 million ounces, I don't really know anything about the market cap, but I'm going to buy it and hope the silver price goes up. And in this market, you might be right in just riding that sort of mentality. But I tell you, on the flip side, when this market does eventually turn, and it will, quoting Rick Rule, bull markets are the authors of bear markets and vice versa. You will have to participate in a bear market. Coming out of a bull, you're going to think you're smart, that you know what you're doing. But if you haven't put the work into learning valuations, to learning how these companies work, you are going to give it all back in the bear. I guarantee that. And so, you pick your approach. And I think most people, if they're honest with themselves, will understand how much work they're actually putting into it. And I can tell you that, it's taken me 9 years to get where I am. So if you think, and maybe there's people that are much smarter than me, they'll be able to pick it up even quicker. But I doubt it. I think that you're going to have to take your lumps and put the time in to really pick these companies right. And therefore, the rifle approach is definitely the better one.
So I don't think I've ever owned more than 10 mining stocks at any given time. I was trying to think about this. What's the most that you've ever owned in your portfolio in the last decade? I know you bought your first mining stock, I think it was in 2000. You said 9 years, but your first mining stock was 2008, right?
Yeah, well, that says, like, I was working a 9-to-5 job. I'm talking 9 years as an independent.
A full-time investor.
Exactly, yeah.
Right.
And to me, I don't even count the stuff before that, because honestly, in retrospect, while I was able to do well in 2016, pick a handful of probably the best performing companies in that year, I still look at what I knew then and what I know now, and I feel like I knew nothing. And like I said before, it's like I still see where I need to fill those gaps in. So if 9 years later of doing this full time, I still see gaps, I can't even imagine, the person that's picking this up newly, as just an interest, something that they saw the gold price is at 3,300 and wondered why. There's a big differential there in terms of lack of knowledge, and you got to close that gap as quickly as possible, but it's going to take time. What was the original?
So the essence of the question is, with the rifle approach that we both employ, what is the maximum number of companies in your portfolio? I've never had more than 10 that I can recall. I'm not going to go back through every broker statement that I've ever had, but I don't recall having more than 10 to where you stay on top of news flow. You're in communication with management. You're watching the stock pretty much every day, even if you have a longer term perspective. You have put all your eggs in one basket, and then you watch it very closely. Like, how big could your portfolio be and still be able to do that?
I think mine's definitely been around 20, or maybe just a little bit over 20. And
is that including your watch list though? The 20?
No. The watch list on the newsletter has probably about the same amount of companies, and then I've got a watch list that doesn't make it to the watch list, that's broken down by, in some cases, jurisdiction, by metal, and then sort of sub lists that I'm thinking about, and they might eventually make it to the watch list in the newsletter. And sort of, for any readers that have read, like, basically any of my picks have come off my watch list. These are things that I'm processing kind of as we go along, and there's different components that sort of break into there. But certainly I've had over 20 companies in my portfolio, and I've seen the downfalls, just as you sort of describe, in terms of trying to follow all of that, and I'm doing it full time. So I can't imagine the guys that are doing this 9 to 5 and feel like they can follow more than 20 companies effectively. I'm not sure that you absolutely can. You're probably missing out on something. And I've even taken that to a greater degree. Right now, the portfolio has 13 or 14 companies, and that's pretty good for me. I probably max out at 15 these days. There's a couple of positions I'm contemplating, but it becomes a lot, especially when the market starts moving quicker. In the bear market, again, you have more time to make decisions. You can be patient. You can wait for the proper moment, and go from there. And when you get into these bull market opportunities, if you're trying to maximize your gains, things are going to move that much quicker. And so I think you want to be more nimble and be able to actually follow this news flow and get your updates on these companies. But again, it's probably an iterative process for most people, where they have to take on too much or more than they can handle, see the downfall of that, and sort of change their approach accordingly. Or maybe you can do it, and good for you if you can.
So you write a newsletter. What are some questions you're getting from your subscribers?
Great question on mindset and or strategy. The reader I've had a number of email exchanges with, and he's new to the sector, and basically he asks how to understand or know whether he should be going after slow marching returns, I guess, so maybe on the more conservative side, or go for the home runs. So, what do you think?
I know I said a couple or whatever show it was, you and I did this, that I'm more, if I have $20,000, I'm more likely to put it to pay off debt, I think I said at the time, which is accurate, versus putting it in a speculation. But then I rethought that, and one of my friends told me, he said, Bill, you're still a gambler. So I guess I'm more of a speculator than even an investor. So, for me, like the slow returns, I guess I'm a high risk, high reward kind of guy, both in how I've like operated entrepreneurially with businesses and just my mindset. And when someone presents me with a potential 10 bagger in this market, I'm probably going to gravitate to that more than, a 2 bagger. But that's factoring in probability too. Like someone commented recently, give me a 3-bagger, a probable 3-bagger any day over a not very likely 10-bagger. And I commented back, I said, me too. Yeah, I'll take a 3-bagger any day. You have to do the probabilistic assessment of what is the likelihood that you're going to get that 3-bagger or get that 10-bagger. But I guess my general disposition is more that of a speculator.
Right. Well, and I basically answered him the way that you just answered. It's all about the individual. I can't answer which one anybody should go after. You need to figure that out for yourself in terms of what your risk tolerance is, what what your timeline is for returns. And then like for me, I've been very public about how I go about it. You just sort of described it. The only difference is for me, is definitely you want to look for those more probable investments, like the three bagger versus the 10. And the only difference might be is that the weighting, I might change. So if it's, I might make that a 10%. If it's a 3 bagger and I can get 10% allocation of my portfolio in it, to me, that's better than, going to a 2 or 3 or 4% allocation for a 10 bagger. Gives me the same differential, but I think the probability is that much higher. And the weighting of the portfolio is something, again, that I changed back in 2024. And it really focused the portfolio on the right companies and the companies I had the most conviction for and was the most confident that the outcome was going to be what it was. And it's paid off in spades over the last 2 years. And I think, again, moving forward with keeping that strategy, without getting probably too aggressive, that is going to be the way that the portfolio separates itself from the other ones that are out there, and me specifically being more successful than unsuccessful.
Any more questions before we move on?
One of the other things, and this is something that I've always really liked in corporate decks. I love when companies have a price chart and they mark out news flow and where it happened on the chart. And you can sort of see how the market reacted to that news flow and and you can surmise yourself of what it might mean to the company. And so the question that's asked is like, do I pay much attention to the previous share price movements before I make a pick? Or as I'm, already in a company, do I look at what, the past is and sort of, I guess, parlay to the future? So what about you? Do you look at the past?
Oh, I think it's excellent. Usually when I've seen that in corporate decks, though, it's been explanatory, especially if it's been a 2-year bull market in junior mining stocks and it's been a trajectory down. Like they'll usually explain, I've seen in the corporate decks, why the share price is down. No, but I love that. And what I also really respect junior mining companies for, when they put in their deck all the warrants and options with exercise price and expiry dates. And you just put that for me in your corporate deck, like much respect to the companies that do that. So then I can assess where in terms of the demand and the supply of shares in the stock price, regardless of what you're doing. I can kind of see that with the overhang there with the warrant and the options. I love when they do that. I also like, Brian, when they put like all their MD&A, their financials, everything. They just have it, the PDFs uploaded to their website to where you don't have to go to cedarplus.ca and, oh my goodness, a little less antiquated than the older version, but bear with all of that antiquation, you can just download it right there or look at it in the PDF viewer on their website. Like, so very much respect. But like the historical approach to see how the market has liked or not liked the news flow, I do think that's important. And I do think you should assess that in, because you can get maybe a lesser quality management team with a lesser quality deposit, but knows how to market, and perhaps the market responds better to some of these companies that may put out, let's say mediocre results, and they don't get the reaction. If you put out stellar results, I still think you're going to get a reaction, even if they're horrible at marketing. It may not be as much of a reaction, but you're going to get some of her. So I guess it would matter more, now that I'm just thinking as I'm talking, with like good, but not like stellar results. And if the market doesn't react to it, then, you ask yourself the next questions in the process. Why didn't it react? Or why was there a sell-off? And then you can't do the full assessment without talking to management, though. Because, for example, one company that when I talked with them, why is your share price going down? Like, what's the volume to the downside here? And it was a new management team, and they said, Bill, because the guy before us, all of his millions of shares are free trading, and his cost basis is like 2 cents.
Really?
So he doesn't care if he's selling at 48 cents or 17 cents. Like, everything is gained to him, and he's done with this company. And it's like that type of intel, Brian, is like, you're not going to get that by looking at a chart. You're not even going to get that by looking at, you have to call management and figure these things out. We're talking about junior mining stocks. There's a lot of new people that may be listening. You've awakened to gold or mining stocks, and you don't have years of experience. So a lot of these things that Brian and I are talking about, these are the smaller stocks, not the Barracks and the Agnico Eagles and the Newmonts that are very liquid and trade millions of dollars a day. We're talking about stocks that might trade $50,000 or less a day.
Right. Absolutely. Yeah. Like I think that's so important, and understanding how that company, I in particular like the companies that have good news flow, or what I interpret as good news flow, and they get no reaction from the market, because to me, that tells me that there's definitely delta there that can be gained if the story comes to the forefront. Like, I think fixing a marketing problem is much easier than fixing a deposit problem or fixing a management issue. So those in particular are the ones that.
But could the management issue be communication? Because if
that's fair.
Yeah.
I just think in my experience anyways, it can be, but I think I shouldn't say more often than not, but just a good percentage of the time, it's just the company doesn't put any time into it. The manager doesn't necessarily value it as much as doing good work. And I can take it that someone would say that's a negative and maybe something you want to watch out for. I totally get that. But to me, I think most of these guys, especially when you get into better markets, can be convinced quite easily that, hey, you should be going to this conference. You should be talking to these people. And once that gets out there and that news flow gets recognized, then you've got that ability to really move. But you're not wrong. You're absolutely not wrong. That can definitely be interpreted. And that's, again, going to come down to experience, whether you're dealing with somebody that's completely inept or they're just not giving it the value of their time that they should.
So when it comes to geological exploration and development, the company and the lead geos will come up with these geological models and apply that to the data that they're getting out of the ground. And then when things like, say, that one company stops, that project goes dormant, another company picks it up, and they apply a new geological model, and then they say, this is where we think that the previous operator got it wrong. This is our model, and because of our model, we think there's this massive exploration upside, which we're going to test here or there. Have you ever speculated in one of those stories and been successful? Like, what's your experience with something like that? To where you speculate before the drill holes come back, based on the geological concept, that this new concept or paradigm that they're applying to the deposit.
I don't think on the grand scale of, let's say, like completely grassroots, where it's like there's nothing. They never discovered anything with their first pass, and then the project was dropped. I'm not sure. I see, because that's not really in my wheelhouse. Like I would hear that, and if I could understand, if they could explain to me the difference between their approach and someone else's approach, I would certainly listen, and it would probably intrigue me. Given where I am in my investment process right now, it would really depend on a lot of other things in terms of how that company, what the business model was, and sort of who the people running it were and what price it was. My experience has been more pertaining to, let's say, metallurgical changes, where, you'll have a metallurgist look at something versus, I shouldn't say a plain Jane's CEO, but somebody whose expertise isn't metallurgy, and maybe they've come in and they said, what we're going to do, we're going to change the mineral processing, the processing circuit, and we're going to do this, and this, and that makes a ton of sense to me. I think, metallurgy, if you want to talk about one of those areas where the average investor completely glosses over, it's mineral processing, the gains that can be made on recoveries are huge. And if you've got the right people involved, and especially the more complicated deposits like the VMS, where metallurgy is probably one of the most important things that you need to understand or find out of, this is where a lot of gains can be made on the flip between one management team and another. And I've have successes that are based, basically solely on that metallurgical process changing. But on the exploration side, like I said, I don't have a lot of examples, or probably none that come to mind right now, but it's also because of how I process how my process for investing in the sector, where I very much stay away from the really grassroots stuff. And it has to be like the right company, probably a prospect generator. And in effect, I think the best prospect generators are the companies that are going out there, they're grabbing land that has never been touched before. And it's based off their geological idea. And they're pushing that forward, and of course, in getting someone else to come in, a big senior company, to do the JV agreement and spend the money to explore it. So that's my experience, and it's been more on the development side. And yes, can be a big difference. And if you understand what the person's telling you, especially if you want to talk about developers, metallurgy is one of those areas to definitely look at and highlight.
Brian, as I think back over the last month of MSE interviews, you conducted a couple of them. I've done a number of them. And one of the things that stood out that I liked was a conversation I had with Rudy Frank, the CEO and founder and chair of Seabridge Gold, trades on the New York Stock Exchange. And I met him at the Rule Symposium, and then subsequently did a interview for the show with him. And one of the things that he shared was about a colossal failure that he had early on when he was at the helm of a company called Greenstone Resources. They were doing 3 mine builds. They were leveraged up too much. And then they failed when the gold market turned over, and those deposits were eventually expropriated from them. And then I said, what do you do after that? And how'd you get another chance? Like, if you go from $1 billion market cap to next to nothing, like, how are you able to do it again? And why did people back you? And he said, number one, I took responsibility for what I did wrong. I owned up. Number two, some people did make money because they were shareholders when the company was small before I built it to $1 billion market cap. So those people, don't forget those gains. Those were real gains that they captured. I suppose the people that bought it at $1 billion market cap and then, had to sell it when it went down wouldn't be as happy. But those people gave him another chance. And then he said, I took what I learned, the pain of that loss, to do things differently in my next opportunity. So I guess I really like that. The reflection I had was when you're talking to a CEO and something in their prior experience where they were in charge of a company in the resource sector, it didn't work out. Have you had those meetings? What was the questioning like? Or because you're pitched for a lot of meetings, do you say, oh man, this guy, like, he did a horrible job with that last company, I'm not even going to take the meeting? Yeah. Like, how have you handled that?
I've come across all of those situations, and each one is a little bit different. The ones that I'm familiar with, and if I really disagree with how they ran the company, I just don't even take that meeting or seek it out in any shape or form. So those ones are really easy. Sometimes the failures aren't as public or as well known. And this typically comes in the situation where it's been brought to my attention and the person wasn't necessarily the CEO at that time. They may have been one of the voices like VPX or one of these influencers on the management team, but not necessarily the leader. And it's been brought to my attention, oh, these guys had this failure or that failure, and it didn't catch my attention on the first go. And I will ask the management teams about those failures, get them to explain what happened, why this time will be different. And if it suffices, I would say that, Rudy's probably not wrong in terms of if these guys are open about where they failed and how they're going to change it. And if you believe it, then it probably can work. And I have, looking at, there's a couple guys that you would probably deem have had a couple issues prior and that I've been willing still to invest in, and it's so far been okay.
Is it because the opportunity was so enticing regardless of management?
Of course.
Okay.
Yeah, of course. That's like the underlying thing is like management is a big topic for me. It is a reason why I would invest. And in some reasons, with some groups or some people, it would be the sole reason why I invest, as crazy as that might sound, considering, how quantitative I am. But there are some people I have an extreme amount of confidence in. And I think, again, if you do start with the right people, more often than not, they are going to pick the right projects. They are going to handle the money correctly. They're going to raise, they're going to spend in the correct way. All those things are going to sort of happen. And if they do come up with a roadblock, they're going to find a way around it. And so, yeah, the people is number one. But if I like the people enough, even though they've had a mistake in the project or that differential in price to value, is where I think it should be. And there's an opportunity there, then yes, then that is certainly what puts me over the hurdle. A guy like Rudy, and again, not that I would dispute, I've heard mixed things about, I'm pretty sure Rudy's a rich guy. And I think that when you're rich or you have a lot of money in the junior sector, you can sort of make your own opportunities without necessarily needing the backing, or backing comes to you because you have.
He told me 95% of his net worth is in Seabridge shares, though.
Oh, I believe that now. Yeah. What I'm saying is, just to the point, there's nothing, I don't know free from a hole in the ground, but I'm just saying, when you have money, you can get away with doing a lot of having failures, or if you've had successes and then you have a failure, you're that much more likely to get a second chance, and rightly or wrongly. I just pointed out that
because of your own money or somebody else's.
Well, it can sort of be both. Some people have backing that, if they've had one success, and even though they might have had a failure, that money's going to back them forward, because sort of what I just said, the person, whoever that money is that confident in that person in executing, and even the best people fail, especially in exploration, that you're going to get another chance. But I think, for guys that have lots of money, they can start their own companies. They can sort of get the boots on the ground without having to ask for money first. Those guys are going to be able to build themselves second chances, just because of that. And that's not a discount, but that's just reality of how the sector works, is money does so much for you. The access to cash, those good people, is such a big factor into which companies are able to move first. And if you look, this is why probably some of the sector is even questioning whether we're in a bull market. You look at last year, all the companies that moved were companies that were probably be in that upper stratosphere of management teams. They've got the access to cash. They're moving projects forward, sort of regardless of where the market is. And I would say definitely, if you're a newbie, this is where you want to stick. You want to stick to those teams that have that access to cash, whether it's the management's own money or they have those backers that have been with them for a while and sort of pushing them forward. Because you look at today, even though you're starting to see your financings ramp up and there's more variation in the number of companies that are starting to get that money flow to them. These companies have really been starved for 3 or 4 years, and these guys are doing, $1 million, $2 million raises at most, just to get by. And they're doing the 1,500 meter drill program. They're doing that small little thing to kind of get them by, keep the lights on, pay their salary. So those become the differentials. And so what I mean is, any of these subjects that we sort of cover, in my view, need to be looked under a lens, and to see why somebody might be getting that second chance, or if they're creating their own second chance, which is fine. Because like I said, money matters. And so if you have it, you can do so many more things, especially in such a cash intensive business like exploration and development, or on the production side of things. So there's no rule of thumb that can sort of blanket everything. And it always comes down to how much you want to understand a topic, and then whatever you interpret it.
So, when in regards to having money, one thing I've seen is junior mining CEOs or directors kind of market their own in the market buying. One thing I've been doing, Brian, is when I see that, like if there's the self-promotion, it's one thing if someone says you're great. It's a whole nother thing when you keep telling everybody I'm great, I'm great, I'm great. So that's a maybe not a red flag, but it's a yellow flag. So I came across one example of this recently, and you already know because I was texting you when I was like, this is ridiculous. And so the bragging about buying in the open market, okay? And then I go and look in what they paid themselves as non-officers, as directors, hundreds, plural, of thousands of dollars as directors. So then when you're bragging about what you're buying in the open market, that's literally just a fraction of what you're actually milking from the company. So you took that money into the treasury from investors, you paid it back to yourself. Now, as a little marketing gimmick, you're buying in the open market with the money that investors gave you. So there's literally no skin in the game in that. And I began to then think more about some other experiences, and even someone with great success in the sector that I was introduced to. And after I was introduced to the person, then I just began to research one of the companies they were with, and there was like a 7-figure payment to this individual. And then so I went back to the guy that introduced me, and I'm like, hey, like, why did he get over $1 million, as a non-officer? What's going on here? And he's like, well, he negotiated this deal that was very transformative for the company, and that was like his deal negotiation fee. So basically the explanation was the value that he brought to all shareholders was great enough to and only he could have got done what he got done to justify that type of payment. I said, okay, like I don't, a man's worth what he's worth. If he made all shareholders money, okay, fine. So then what I did was I began to research other companies that he was a director at, and the pattern began to emerge that it's not an unpaid director position. It's not even a director position with options. It's a director with always some form of monetary compensation in addition to stock compensation. So the point I'm bringing up, because I know that there's a lot of new junior mining speculators or investors that are listening to us, is that these guys know how to extract money from investors, and they make sure that they get paid. Whether it's successful or not, they are going to get paid. So that's point one. Point number two, Brian, a question I'm going to throw out to you. The famous names, the people that have good reputations, to what degree do they also do what I'm talking about to some measure, whether greater or lesser?
They absolutely do it. I've come across a number of cases if you dig deeper. Especially the biggest examples would be the founder shares. It would be the fraction of a penny, the 0.001 pennies for the first 100,000 shares they get of a company. And again, it's all the big names that I've seen on there, and I'm not going to cast mud on everybody. But again, like this, what we're talking about is all about how much you want to dig. And to me, it is a little bit disheartening in a way to sort of see that, because it seems that not the whole sector, but there's a good portion that have done it at some point. And it's certainly not with all their deals, but there's seemingly going to be a lifestyle company that's associated with most of the individuals in some shape or form. And so if you want to find those things, it's easy enough to find, easy enough, but hard, because CDAR, like you mentioned earlier, is cumbersome, and you have to understand which documents you're looking for. But they're there. And so you can find it. it's an interesting topic because, again, it's going to be subjective and on how you want to interpret that and how you want to take that forward with the other companies you look at and what your comfort level is with these various sort of settings for each of the companies. The one that you started off talking about, this is like the perfect example, and it should be the case study for people because they were so open about how crazy their business model was. Like the amount of marketing they had set up in that first financing, the people that they had blanketed in the early seed rounds and the founding share rounds. That company was built to reward those people with cheap shares, and the marketing that they brought into those early rounds was supposed to be the ones that bring that liquidity. And they were very open and honest about it in all the social media. And it's crazy to think that I wonder if they didn't do that, whether people would still have caught on as quickly as they did. Like my thinking is that they were so brazen in coming to the market and telling them that they thought, oh, they convinced themselves that this is the way you should run a junior mining company. But it is coming back to haunt them, and this should be the ones that people seek out to look at, to learn from. Because the way that company is structured is your perfect lesson on how the pump and dump works in the junior resource sector. And I think that's sort of key. And you can parlay that to all the other companies you look at. And then it's going to come down to that subjectivity of how and who you want to invest in moving forward. But, the guys like that that are so brazen in their motives and their arrogance and how they present it to the world shouldn't be rewarded. And we'll see how that ends up going.
But they actually present it moralistically too, which was part of the ridiculousness in my assessment. But what I've noticed is that there's not necessarily a junior mining blacklist, and that these guys can go on and operate, indefinitely. Maybe it's easier in a bull market in a given commodity, but it doesn't seem like the market 100% weeds these guys out. Maybe it's because, to your point earlier, if you have money, you can keep operating. Yes. You can make a lot of money on pump and dumps. You can have companies out that you set up in the Bahamas that you don't report the shares, and you just have whatever your cousin or your wife sell those for you, and you make a lot of money, and so you can just move on to your next thing. But it's almost like there's an unspoken rule that I'm not going to expose you because I don't want to be exposed. It does seem like there's a little bit of that operates in the Canadian junior mining sector.
And there probably is, but I think it's a lot simpler. I think that a lot of people benefit from being involved, or like, not even what I mean being involved is like, oh, we're going to do this. This is the company we're going to promote. You can get in at this share price. Give me 10 or 15,000 bucks. You participate. They double that money. Everybody's happy. And really, I think what happens is when people are making money, this is really what tests your morality, or it certainly puts it to the test in terms of how you want to approach it. That's why I say this is very subjective, because you can still make money, speculating in these sorts of companies. And to what degree, especially I think how you were framing that is the people that are that much closer, the other people that are the other management teams, the sort of brokers that do those deals, those guys are making money from it. And I think that's why it gets perpetuated. And, people typically only want to take a negative view when they lose money. And that's probably where broad-based the issue is. And again, like, I think we're all pushed to a certain degree. You can see when companies get more generous with themselves as they make people more money. And of course, you as an investor are always that degree of, well, how generous should they be and with themselves? And, if you're bringing, you made a share price change from $1 to $5, yeah, you were probably a big part of it. And yes, you probably deserve whatever that maximum is. But what that maximum is to each individual shareholder or investor is the bigger question. Some people might view that, X amount of options or bonus as egregious, and others might think, oh, that's exactly what it should be. You gave me a 5-bagger, and then therefore you should benefit from that too because you're running the company. you as an investor are going to have to make that decision. But I think, it gets really easy though in situations like this where it's so brazen and so in your face that it's like, man, there's not much to say. Like, I don't know how you can really defend it. It does not make any sense. And the further you go, it's more than just the founder shares. It's how that company was set up and what they're doing. Like, can I contrast that? Can I give an example?
Yeah.
And again, I know this company from a very high level, a past guest. Colby Kushner was on the thing. He was talking about lithium at the time. He was an analyst at Red Cloud.
You interviewed him like 2-3 years ago, right?
Yeah. He had a
private
lithium company. I never invested, definitely listened. Much respect for Colby. One interesting thing they just did, they're going public. They have all of their founder shares, at least from what I read from my understanding from the news release, is basically all their founder shares, all the insider shares are basically tied up until that company has an exit, meaning they're bought out or something of that matter. And they're doing that right from the very hop on that go public. Again, when you look at that spectrum of things, that is definitely on the other extreme to the situation we were just describing. And I think if you had question marks, I'm pretty sure there's some cheap founder shares in that lithium company. If you look back and you can think whatever about that. But Colby, he was pretty good. Like, I remember we were talking about that, and I think they did make a change to what they originally were going to do in that regard. But you can see how he set up the company and how he was moving that forward. To me, when you have that sort of architecture in the company right from the very beginning, that's sort of what makes it easier for an investor to look at. And this can be a question you ask, especially on the IPO or RTO side of things, is, what's the escrow? How are these shares? How are we going to be protected versus the cheap shares that might be in there that maybe you don't know how to find? But these are questions you can ask the IR, or most importantly, ask the CEO. And I think this is something like, we've talked about, and I think you've mentioned on the show before. One of the first questions that you ask is about that share structure and how management is situated on that structure. And to me, I think you should just maybe mention it, is how that plays into your role and taking meetings and this sort of thing.
And you always got to ask, what other family and friends were in that founders round? Right. Like, that's what I got burned on a CSE pre-IPO deal that I did back when. I've mentioned it in passing over the years, but I invested at 10 cents. And then after I gave my money, they issued themselves 1 cent paper to a bunch of family and friends. And so I was not happy about that at all. And I will never invest with that individual again. In fact, I had a call about 2 months ago and somebody brought his name up to me. And I said, I'll never invest with that guy ever again. And here's my experience. Anything else, Brian, as we conclude? What other thoughts you had over the past month that would be pertinent?
Yeah, the only other thing, like, we're talking about past interview, like I interviewed Chris Berry from House Mountain Partners, and to me that conversation was so important. Critical minerals, obviously that blanketed thing has been a topic in the resource sector for a number of years now, but the rare earths have really come to the forefront in terms of this deal with the US DOD and MP Materials. And I thought, Chris's thoughts on it were excellent. I think that whole conversation is something that, for anybody who's interested in that sort of narrative, should probably revisit and listen to what Chris had to say. I'll add my little twist to it because it's something that I've been thinking a lot about and I've been talking about in the newsletter to a certain degree. But just how opaque the rare earth market is. And although you're getting price support for MP Materials with what the DoD is proposing, this 10-year price floor, I'm telling you, like, that market is still very much the pricing is opaque, and there's a lot of risk associated with that because how do you evaluate those companies? Do you use the DoD's floor pricing? In that case, there's a lot of projects that begin to look very good, or do you use the current pricing, which is about half of that? And you're going to have to make that decision yourself in terms of how you look at the market and want to speculate. But I'll tell you, there is a ton of ambiguity in terms of where that is headed. whether that's going to be more government influences ahead, which depending on your perspective may or may not be good, but just how you're going to play it and how you're going to protect yourself moving forward, because there are so many question marks ahead. And you can see some of the share prices of these companies, rightly, wrongly, have certainly moved. And to me, I wonder if investors fully know what they're speculating in and the amount of risk that they're taking, considering how many unknowns there are out there. But I think critical minerals with the slash of rare earths is going to be a huge topic moving forward. You can hear Chris talk about that conference he was in Detroit, and how the narrative has definitely flipped necessarily from that critical minerals to more maybe a defense minerals sort of topic and narrative moving forward. So I think, you can parlay that into a number of different segments, whether it's copper, the rare earths, lithium, probably to a certain degree, and the list goes on. But I think this is a really interesting portion of the sector to sort of focus on, but really understand the risks you're taking, especially on the rare earth side, because it is not straightforward.
Okay, so I've always been advised, since I've been doing this, by some mentors, Bill, just avoid what you just termed the opaque markets. Like rare earths, it's absolutely crazy. There's 100 different metallurgical processes or more to extract. There's like 17 or whatever it is, different rare earths. We can't even name them. We don't even know them. We can't find where they're priced. Like, it's just so complicated and opaque, and it's a niche market that niche markets are easier to be manipulated. It's not like China can just go manipulate the whole worldwide copper market, right? It'd be a lot harder than manipulating the rare earths market. So I've always been told, avoid it unless you think you're in on the early stages of basically a pump, because it's kind of like the last man in is the biggest fool and you guys all get his money, is how it was explained to me. Has that been your approach until the United States government got behind projects like this?
Completely. Yeah. Like, I'm always intrigued. I think with my background as an engineer and sort of understanding the industrial side of things, I can't help but be interested in, rare earths and sort of how they parlay into magnets and the narrative I buy. Like, I think the world that we're in, and you could argue headed into, probably only becomes more divided. And I think that the narrative becomes more and more true. And that's sad, but it's also, there's opportunity there. But the more I dug into it, I just thought to myself, man, like, there's so much that I don't know. I can't, the basis of how I invest in the sector is price to value. Well, what price do you use? Like, in terms of metal price, what is reasonable? Is the DoD going to give a floor to all North American companies, or all G7 or Western based companies? Like, these are weird questions that need to be answered, I think, for you to speculate effectively. Now, there's tons of momentum money. There's a number of stories that people are into and they're making money or not, or who knows what that actually looks like in reality. But yeah, like, if you stick to the big sectors, gold, silver, copper, more often than not, you're going to find better quality companies, and they're going to be more, it's going to be more clear in terms of pricing on how to value those things, the liquidity in and out of the stock, attention. The bigger markets are definitely, in my experience, the better place especially for a newbie, to be placing money.
Anything else?
No, I think that's pretty good.
All right. Well, we appreciate your listenership. Look forward to another month of interviews from myself and Brian. If you're new to mining stocks, you can go check out MiningStockEducation.com, as well as Brian's website, JuniorStockReview.com, and we'll catch you on the next one.